In our last video, we looked at a sample company and we went ahead and computed their pension expense for 2017, and we talked about how it was a component of these 5 things right here: the service cost, interest cost, expected return on plan assets, and amortization of any actuarial gains or losses, and amortization of any prior service cost. Now I want to go ahead and show you the journal entries that we would make to reflect this increase in pension expense. So first of all, we're going to have a debit, right? Because pension expense is an expense like any other. So we're going to have a debit to pension expense. Then the question is how much? Well, we already calculated that in the last video, so I'm not going to go into it too much. But $62,000 is going to be our amount, right? So we've got a debit for $62,000. Now the question is, what do we credit it for? And you might be thinking, well, heck, we'll just credit it for liability for $62,000 as well. But it's not that simple. And so first off, I just want to talk about how we would even get this liability number. So with the liability number, basically what we're doing in this case, this $55,000, is the $65,000 service cost, right? That's the 2017 service cost, plus the $8,000 of interest cost, right? Because both of these increase the PBO. The PBO is the projected benefit obligation, right? So the PBO is increased by the service cost and the interest cost. But plan assets, right? The plan assets are increased by this expected return, right? So $18,000 we're expecting will increase plan assets, right? So this part will be increase the PBO, our obligation, and then we have an increase to assets, right? And remember that the funded status of our pension, what shows up on our balance sheet, is going to increase here, assets. The amount that's going to show up on the balance sheet is the net between the PBO and the plan assets, right? That's basically our funded status. So we're going to have $18,000 here. So basically we're going to subtract this $18,000, the increase in the assets, from the increase in the liabilities, right? And we see there's a higher increase in liabilities than there is an increase in assets. So this $73,000, which is what this adds up to, minus the expected return on the plan assets, that gives us $55,000. Now, we have an offsetting credit. This has to balance, obviously, right? So we need a credit for $7,000. And so that's going to be the amortization of the prior service cost. Now, we had talked about in our example that this prior service cost was we had actually granted to some employees some additional service time. So they had worked there 15 years, and we said, well, we'll count it like you've worked here 18 years. So we actually are giving them, we're increasing our obligation to our employees in terms of the pension. So you might be wondering, well, why is this a credit of $7,000? Why isn't it, for example, a debit? And the reason is that there's another entry that's actually involved, that not with the pension expense itself, but when we actually grant that prior service cost, we're amending our plan, and so we'd had to make an entry for that, right? Because this is just the amortization. Let me write this in here. Amortization of the prior service cost, right? But that's not the actual amount of prior service cost that we granted. So let's just say that the total amount that we amended our plan for, we asked the actuaries and they say, you know what, it was $70,000. So then when we did that, we would have said, we would have debited other comprehensive income, prior service cost. We would have debited that for $70,000. Okay. And then we would have credited pension liability for $70,000, and then let me make sure that credit is indented there. So we would have credited pension liability for $70,000. So this would have been reflecting the fact that, hey, look, we gave some actual prior service cost benefits to some employees, and that increased our liability of our pension by $70,000. We're going to have to pay an extra money over the course of the retirement for those employees. So now here, the $7,000 is the amortization of that amount, right? And how do we amortize an account? So if we think of OCI for prior service cost, if we think of a T account for OCI, and we debit it initially when we grant that $70,000, we debit it, right? Because we're crediting a liability, so we're debiting this OCI. Well, now to get this OCI zeroed out, to get it ultimately to zero, what we're going to do is we're going to amortize it over the the remaining service period of the employees. And let's just say that we thought, okay, well, there's going to be a 10-year remaining service period. So then we just divide the 70,000 by 10, and that tells us, okay, we're going to have to make a credit here of 7,000, and then next year we'll make another entry, etc. So that's where this amortization of the prior service cost comes in. I just didn't want you to, I think I just pulled this number out of nowhere, right? So, and now ultimately also, if we had some, now we talked about in our example with the net actuarial gains and losses, that we said that we didn't have any amortization relative to that, right? And that's things like maybe the actuaries changed their assumptions, or there was some corridor amortization. We just said that that was zero, right, in our problem. And I'll make another video where we talk about that in more detail. But the mechanism is similar, where basically if we had some OCI related to that, then also that could also end up here as well, right? Not in this example, but in another example, we could have some OCI actuarial gain or loss, right? And then we'd also have an entry. So that is related to the amortization, right? The amount that gets outside the corridor. And then we would also have an entry when there's a difference between the actual return and the expected return, right? So then we could actually, let's say that there was some kind of entry there, we might have to make an entry where we debit OCI and credit pension liability, or we credit OCI and debit pension asset. And bear in mind, here's something too, I just want to make sure you understand. This credit here, pension liability, we will not always have a credit. It might actually be a debit to pension asset, right? So if this number, so we calculate this number up here where we said, okay, we got our service cost, we add the interest cost, and then we subtract the expected return, right? And because the service cost and the interest cost were greater than the expected return, that's going to increase our liability, so we make a credit to a liability. But if that weren't the case, if the expected return, right, if this was instead of 18,000 was like 100,000 or something, then we're actually going to have an increase. So we're not going to be crediting a pension liability, we'd be debiting a pension asset.